Micron is set to report earnings on June 24th. Therefore, this is the right time to review the stock and make up our minds whether Micron deserves a place in our portfolios either before or after the results. So let's start. Over the last few years, Micron technology has experienced jaw-dropping growth relative to the broader market. Driven by massive pivots in technology, its performance charts a vastly different trajectory relative to the S&P 500. While tech giants battle for software supremacy, Micron has quietly turned a component most investors spent years ignoring into the most irreplaceable bottleneck in the global economy. Over the trailing 12 months, MU has delivered an astronomical hyper-growth outperformance against the S&P 500. Micron has given investors an approximate return of 892%, surging from roughly $122 to over $1,211, while the S&P 500 has returned 24%. When you judge Micron purely by standard stock screeners, it looks dangerously expensive. Trading at a trailing 12-month PE ratio of 57 times, it sits roughly 3 times higher than its 10-year historical average in the range of 13 times to 19.5 times. But in the semiconductor world, trailing metrics are a complete illusion because semiconductor profitability moves in explosive cyclical waves. A trailing multiple only tells you what happened before a production ramp fully matured. The true reality of Micron's valuation is hidden in its forward estimates, and compared to the rest of the semiconductor industry, it reveals a massive structural valuation gap. When you swap the trailing window for consensus Wall Street forward estimates, Micron's multiple undergoes a violent compression. Micron trades at a forward PE of approximately 9.9 times to 11.7 times. This sudden compression happens because Micron's underlying earnings per share base is erupting. Analysts project full-year consensus EPS to scale to roughly $61 by the end of its current fiscal cycle and balloon up toward $97.77 per share into the next fiscal year, when a company expands its earnings power by nearly 1,000% year over year. The high multiple rapidly deflates. When placed side by side with its mega-cap semiconductor peers and the broader chip tracking index, Micron trades at an aggressive systemic discount. Nvidia trades at a forward PE of 23.6, a 100% premium to Micron. Similarly, Broadcom trades at a forward PE of 27.1 times, signifying more than a 100% premium to Micron. U.S. semiconductor industry median is 30 times. Niche global memory suppliers are in a similar situation as Micron. Their forward fiscal multi-year outlook remains structurally compressed. Micron's forward-looking run rate, 9 to 12 times, are comparable to peers like SK Hynix, approximately 9.5 times, and Samsung Electronics, approximately 12 times. If these memory providers' modern high-bandwidth memory, HBM3E/HBM4, platform is completely sold out through next year, why is the market allowing it to trade at 12 times forward earnings when the industry median commands 30 times? The answer is commodity stigma. Historically, Wall Street treated memory makers as pure commodity businesses. During past cyclical peaks, investors typically capped Micron's PE multiple below 8 times because they feared that as chip makers rushed to scale fabrication facilities, they would oversupply the market and crash pricing. The core investment thesis right now is whether Micron deserves a premium AI platform multiple similar to Nvidia or a legacy cyclical commodity multiple. Because its 97% marginal gross profit margins on newly added revenue show unprecedented platform scale, the 12 times forward multiple indicates that the market has only partially priced in memory as an enduring piece of AI infrastructure. At 12 times forward earnings, Micron isn't priced like a high-flying tech darling. It's priced like a defensive value stock disguised in an AI uniform. If the hyperscale data center capital spending wave holds up through its upcoming earnings report, This forward discount implies there is still massive structural room for valuation expansion. Coming to the financials, Micron completely shattered expectations during its March 18th, 2026 update, rewriting the record books across revenue, gross margins, EPS, free cash flow, and operating margins. This explosive performance is fueled by intense AI-optimized data center demand, bumping up against a severe industry supply crunch, sparking a massive bidding war that has sent component prices soaring. Management expects this legendary run to continue, forecasting even more records next quarter. In its most recent quarter, Micron generated a staggering $23.9 billion in revenue, nearly tripling the $8 billion recorded in the same quarter last year. This monumental revenue scaling came with a massive expansion in profitability. Gross margins more than doubled to 74.4%, putting Micron right in line with Nvidia's elite profitability levels. Operating income experienced a jaw-dropping leap from $1.8 billion last year to $16.1 billion, yielding a 67.6% operating profit margin that ranks Micron among the most hyper-efficient corporations on Earth. To lock in this dominance, Micron has been aggressively deploying capital, pouring $5 billion into manufacturing expansion last quarter alone. This represents a massive 25% capex to revenue ratio, a heavy infrastructure spend the company has maintained for several consecutive quarters. Yet, even after funding this multi-billion-dollar expansion, the business still generated a massive $7 billion in free cash flow. Looking ahead, management's forward guidance is genuinely mind-blowing. They are forecasting next quarter revenue to hit $33.5 billion, a massive, near 50% sequential jump of $10 billion over a single quarter. Crucially, Micron isn't using promotions or discounts to drive these eye-popping numbers. Instead, they are aggressively raising prices to capitalize on the ongoing bidding war. As a result, management expects gross profit margins to soar to an unprecedented 81%. For a vertically integrated manufacturing company selling heavy physical products out of its own fabrication facilities, unlike Nvidia, which completely outsources its chip production, maintaining a software-like 81% gross margin is practically unheard of. While structurally unsustainable over the long macro cycle, it is an absolute goldmine while it lasts. This operational surge is clearly visible in the 3 months ending February 26th, where cash flow from operations nearly tripled year over year to $12 billion, up from $4 billion. After dedicating $5 billion to property, plant, and equipment, Micron was left with a massive mountain of excess free cash flow of around $7 billion. Micron is looking ahead to an absolutely massive future, and it all boils down to one simple problem. The world wants way more AI memory than factories can actually produce. Looking at Micron's official outlook, the tech giant expects severe supply-demand constraints for both DRAM and NAND to stretch well beyond 2026. Why? Because building advanced AI chips like their brand new HBM4 modules shipping for Nvidia's next-gen Rubin architecture is incredibly complex and eats up massive cleanroom space. Micron expects the broader industry's DRAM shipments to grow in the low 20% range and NAND by about 20% in 2026, and they are matching that growth step for step. To fix this massive supply gap, they've gone into hyperdrive, closing a major site acquisition in Taiwan and prepping new cutting-edge fabs from Idaho to New York. For investors and tech fans alike, Micron isn't just riding the AI wave. They are building the infrastructure that dictates how fast the entire AI revolution can actually move. A company can be the absolute best at what it does, but until and unless it's available at a fair price, it's not considered a good investment. So let's evaluate whether Micron justifies its above $1,200 price tag. On the surface, Micron looks absurdly cheap, trading at just 11 times forward earnings and 12 times forward price to operating cash flow. While these metrics are roughly half the multiple of the average S&P 500 component, investors must remember that semiconductor manufacturing is a fiercely cyclical industry. Right now, Micron is experiencing the absolute peak of its cycle, meaning the denominator in these valuation equations is artificially inflated by record-breaking earnings and cash flows. If you normalize these metrics across a standard 5 or 10-year average, the stock looks significantly more expensive. Historically, chip shortages always trigger aggressive capacity expansion across the industry, which inevitably leads to a supply glut. While AI has created a powerful structural demand shock that will prevent sales from completely cratering, the rate of growth will inevitably slow down after next year as the industry transitions from an explosive adoption phase into a standard replacement cycle. Looking at the discounted cash flow model, considering that the demand for memory is strong and some analysts see 3-year annualized earnings growth projected at 33.7% per year, outperforming the broader US market, which averages 18.9%, plus long-term forward momentum pushing fiscal year 2027 EPS toward $82.67, we get a fair value of $1,440 for Micron stock. Of course, since valuing such businesses far out into the future is next to impossible because no one knows when memory slowdown begins. So we would have to take this figure of $1,440 with a pinch of salt and evaluate the company every quarter. Sensitivity analysis gives us a completely different answer. If we assume the same 33.7% EPS growth rate as we did in our discounted cash flow model, which coincidentally is also close to Micron's 5-year EPS compounded annual growth rate of 32.6%. And if we assume a projected long-term PE ratio of 30, which is close to half of what it's currently trading at, that is 56. We get a fair value of around $2,379, which is a lot higher than $1,440. If we average our two findings, we get a value of around $1,910. Given that the semiconductor industry carries immense structural risk, which is strictly defined as high variance and wild earnings volatility, I require a strict margin of safety well above the standard 10%. While steady consumer staples like McDonald's enjoy flat, predictable earnings regardless of the macro environment, Micron's massive cyclical swings make it much harder to manage and plan long-term resources. Because the current market price sits within our adjusted margin of safety, I would rate it as a cautious buy. However, if you are looking to deploy new capital, do not buy the stock immediately ahead of the upcoming earnings release. Entering an earnings event after an 800% run introduces extreme short-term variance where the downside risk heavily outweighs the remaining upside. The most prudent move is to stay patient, wait for the results to drop, thoroughly digest the management commentary, and execute your strategy once the post-earnings volatility clears.